Your bank doesn't hand you someone else's savings when you take a loan. It creates new money the second you sign. And once you see how money creation actually works, the chaos in your rent, your groceries, and your investment starts making uncomfortable sense. You felt the symptoms. Your rent jumped by $200 last year. Eggs cost more than you remember. Your credit card minimum looks harmless until you realize most of it is interest. And when rates jumped in 2022, a 30-year mortgage that used to cost $2,000 a month suddenly cost $2,400 for the same house. That isn't random. That's the plumbing of money creation pushing on your life. Most people think the government prints money and banks pass it around like a bucket brigade. But if you've ever wondered why everything speeds up and booms and feels frozen and busts, the reason is simpler than you think and closer to you than you'd expect. Here's the part you were never taught. Most of the money you use doesn't come from a printing press. It's born inside banks when credit is created, not after, during. And that's where your prices, your paycheck's power, and your debt all collide. Picture a small-town bakery. Maria runs it. She wants a second oven and a bigger storefront. Price tag, $100,000. She walks into her bank. The loan officer approves it. What happens next isn't the bank taking $100,000 from someone's savings and handing it to Maria. The bank types numbers into her account. Her deposit goes up by $100,000. On the bank's books, her loan is an asset. Her new deposit is a liability. Brand new money just appeared. But here's the twist. It isn't magic. It's a contract. The money appears because Maria promises to pay it back with interest. That promise is the engine. When she pays contractors, the deposit moves through the banking system. If the contractor uses a different bank, Mariah's bank sends reserves, think of them as the bank's money, to the contractor's bank to settle. You never see reserves. You see deposits. Deposits are the money you and I live in day to day. Every swipe, every bill pay. That's the ocean we swim in. So why does this matter to your rent? Because when banks create more deposits through lending, there's more money chasing the same number of apartments, cars, and stocks. Prices rise fastest wherever credit flows easiest. During a housing boom, mortgage lending explodes. That extra deposit money bids home prices up. Landlords refinance at higher purchase prices and higher interest rates. So your rent reflects not only demand but the credit cost baked into the building's mortgage. Wait, it gets stranger. Money doesn't just appear this way. It disappears the same way. When Maria pays down her loan, the bank reduces her deposit and the loan balance at the same time. Poof, money vanishes. Loan by loan, payment by payment, the money supply shrinks. If banks lend aggressively, deposits grow. If people repay faster than banks lend, deposits fall. Your economy breathes in and out with credit. Here's what nobody tells you. The central bank, like the Federal Reserve, doesn't hand out spending money to you. It mostly controls the conditions of the room. The temperature, not your grocery list. It sets the short-term interest rate, which changes how expensive it is to borrow. In 2022, the Fed raised rates quickly. Mortgage rates doubled. Credit card APRs jumped. Banks still create money when they lend, but now borrowing feels like lifting weights with a backpack full of rocks. Less new credit gets created, so money creation slows. That's why your home buying plans suddenly felt impossible. But there's a catch. Banks can't create infinite money. They face constraints. They need enough capital to absorb losses, enough reserves and funding to settle payments, and enough good borrowers with income to pay loans back. The Fed's rate sets the price of that funding. If deposits leave for money market funds paying 5%, your bank has to match with higher CD rates or borrow elsewhere. Lending dries up when it's not profitable or safe. So yes, banks create money, but not for free and not forever. Quick reset. Remember Maria's bakery? She spends the $100,000, contractors get paid, suppliers hire extra staff, customers see more bread. The town smells amazing. Credit creates deposits. Deposits create demand. Demand creates jobs. When it works, growth feels effortless. But the bill comes later. The loan must be serviced. That means future income flows back to the bank with interest. So money creation carries a shadow: debt. Every dollar of bank-created money is someone's loan. And this is where things get interesting. Most money in the economy is bank deposits. Cash in your wallet is small. Government-created reserves live behind the scenes, between banks. When the Fed did quantitative easing and bought bonds, it created reserves to pay for them. Asset managers sold bonds to the Fed. Their banks got more reserves, and deposits often showed up in seller accounts. Asset prices climbed. But buying groceries didn't double the next day because reserves don't jump directly into your cart. Government stimulus checks were different. When Treasury spent, your deposit rose, new money to you, because the government credited accounts. Different pipe, same pool, deposits. If you felt whiplash between 2020 and 2023, this is why. In 2020, banks lent, the government spent, and deposits surged. Stocks rose, crypto took off, housing sprinted, then the rate hikes hit, borrowing slowed, mortgage applications collapsed, refinancing died. Suddenly, the same house felt twice as expensive even if the sticker price barely moved. The pipe narrowed, but here's the part that changed everything for me. Inflation isn't just too much money. It's too much money chasing specific bottlenecked things. In 2021, we had both credit and government cash and supply chain snarls. More deposits tried to buy cars when auto production was jammed. Prices jumped. Later, as rates rose, goods inflation cooled. But services tied to labor and housing stayed sticky because credit still fed into rents and wages with a lag. If you've watched your lease renew higher months after headlines say inflation is falling, you just witnessed credit's time delay. You might be wondering, does your savings account matter in this story? Absolutely. Deposits created by lending become someone else's savings. When Maria pays the contractor's bank balance rises. That's savings funded by credit somewhere in the system. It's all connected. And when you hold a savings account at a bank, that bank funds loans with it, or replaces it with other funding if you leave. Your interest rate is the rent your bank pays you for your money's loyalty. But here's the twist most textbooks skip. Banks don't need your deposit first to lend. They lend if they judge it profitable and safe, then they find the deposits or funding to match after. That's why credit booms can snowball. Lending creates deposits, which improve the appearance of liquidity, which encourages more lending until losses appear or funding costs spike or regulators tighten. Then the snowball rolls uphill. Let's ground this in your decisions. Should you take a variable rate loan? When the Fed is hiking, your payments can leap. $1,000 at the start can turn into $1,300 fast. Fixed rate gives you a shield. Should you build an emergency fund? Yes, because when credit tightens, layoffs follow. Companies that relied on easy credit pull back. Your cash gives you time, and the higher rate world now pays you for waiting with T-bills and money market funds yielding more than you've seen in a decade. Should you pay down debt? When you reduce a high rate balance, two things happen at once. You destroy money in the system, and you build your net worth. Your personal balance sheet gets stronger while your future cash flow frees up. And this is where the secret turns into power. Watch the valves. Bank lending standards tell you where credit is going. The Fed's Senior Loan Officer Survey reveals whether banks are tightening or easing. Mortgage applications show future housing activity. Credit card delinquencies warn you when households are stressed. When these gauges tighten, risk assets wobble and job postings thin out. When they loosen, risk appetite returns and growth accelerates. You don't need an economics degree. You need to track the pipes. Remember Maria? If banks tighten after a scare, her second bakery might stall. Contractors sit idle. Suppliers reduce orders. That's not because people stopped liking bread. It's because the oxygen, new deposit money, stopped flowing at the source. In 2008, mortgage credit collapsed. Money creation flipped into money destruction as loans were written off, and everything spiraled. Policymakers responded by lowering rates to zero and backstopping banks so lending wouldn't freeze completely. The lesson? Credit drives the cycle, and money creation is the accelerator pedal. But there's a catch we haven't touched yet. What about printing money causing runaway inflation like you hear in extreme cases? In places with weak institutions, governments sometimes force banks or the central bank to create deposits to pay bills without corresponding production. Then more and more money chases fewer goods, and trust collapses. In advanced systems, rules, capital requirements, and rate policy aim to prevent that. The risk isn't just hyperinflation. It's also credit droughts that strangle growth. Both are bad. Balance matters. So how do you play this with your own wallet? 3 moves. 1. Match your debt to the environment. In rising rate periods, avoid floating rates, refinance to fixed if you can, and attack high-interest debt first. 2. Position your savings where the new rules pay you. Treasury bills, high-yield savings, and money market funds are simple, liquid, and finally rewarding. 3. Make big purchases when credit is bruised, not euphoric. When lending is tight, prices soften and sellers negotiate. When lending is loose, everything runs hot and you end up overpaying. Here's your unfair advantage. See money as a flow created on demand, not a pile that pre-exists. When you hear banks are tightening, translate that to less new money. When you hear mortgage rates fell, think more oxygen for housing. When you see deposits rise without more stuff to buy, expect pressure on prices. And when you understand that paying down your own debt is silent wealth creation, even as it shrinks system money, you stop treating balances as background noise and start steering. You started this thinking money creation was a government's printer. Now you know the truth. Banks create most of the money you use when they lend. It disappears when loans are repaid. And the cost of credit, set from above, decides how fast that heart beats. That's why your rent spikes, why your mortgage quote swings, and why your investments ride a credit tide you can finally read. You don't control the valves, but you control where you stand relative to them. Choose fixed over floating when rates rise. Keep cash where it earns. Watch lending data like weather. Time major moves to the cycle instead of to headlines. Money isn't found, it's made. And when you know who's making it and when, you stop guessing and start positioning.